So, December 26th, 2025, a day you'd expect to be pretty quiet in the markets, right? Well, something absolutely dramatic went down in the world of silver. In this breakdown, we're going to deconstruct exactly what happened that day and dig into the powerful market dynamics that, according to our source material, were at play. For years, that $75 mark for silver, it was like a line in the sand. Our source material paints it as this massive wall, the place where every single rally before this one just ran out of steam and died. A lot of people really thought it was unbreakable. But on that Friday, boom, the price didn't just tap the ceiling, it completely smashed right through it, closing out the week at $75.60. And remember, this wasn't just some gentle nudge, it was a decisive breakout, and it happened on a day with super thin holiday trading, which makes the whole move even more powerful. Okay, so the big question is, what on earth just happened? What forces came together to cause a move this big, this fast? To really get it, we've got to pop the hood and look at the actual mechanics of the market. And trust me, this is where the story gets really good. All right, first up, let's dive into what our source material calls the anatomy of a squeeze. We're about to break down the technical gears and levers that were set in motion the second that $75 level gave way. So, the main engine behind this whole thing, according to the analysis, is something called a gamma squeeze. And the thing you really have to get here is that this isn't about feelings or investor hype. Nope. As the slide says, it's a forced buying event. It's a mathematical chain reaction where the people who sold the options have no choice. They must buy into a rising market, which only pushes the price even higher. And this slide right here, it lays out that feedback loop perfectly. The source explains that once the price ticked over $75, it was like a tripwire. Suddenly, millions of call options are in the money. Now here's the kicker. The banks who sold those options, they are forced to buy silver futures to cover their risk. And what happens when you have a ton of forced buying? You guessed it, the price gets pushed higher, which just starts the whole cycle all over again. It's pure mechanics. And the timing here was just perfect. Or, disastrous, depending on which side you were on. This all went down during what the source calls Ghost Week, that sleepy period between Christmas and New Year's. With almost nobody around to sell, all that forced buying had a huge amplified effect. It sent the price rocketing up just to find a seller. Okay, so we've covered the mechanics, but what about the human side of this? For every trader cheering this on, there's someone on the other side of that bed. And for them, well, our source describes this event as an absolute nightmare. Yeah, psychological torture. That's the phrase the source uses to capture what it must feel like to be short silver right now. You're trapped in a losing trade, you're leveraged up to the eyeballs, and the market is closed for the weekend. All you can do is sit there, watch the damage, and dread what's going to happen when Asia opens on Sunday night. So you've got these two totally opposite mindsets, and they both actually feed the rally. On one side, you have the short seller who is desperate to buy at any price just to stop the bleeding. They become forced buyers. On the other side, the analysis shows retail investors who were maybe skeptical before are now diving headfirst into the fear of missing out stage, or FOMO, which could bring in a whole new wave of buying. All right, let's pull the camera back a bit, because the analysis says that if you're only looking at the New York price, you're missing the bigger picture. They use this great analogy of a broken thermometer, suggesting that the $75 price, as high as it seems, isn't actually telling you the real temperature of the global physical market. And this chart really shows you what they mean by that broken thermometer. Just look at this disconnect. New York's paper price hit $75.60. But in Shanghai, where they're treating actual physical silver, it's already near $80. And if you wanted to buy actual metal on the street, reportedly closer to $90. This gap between paper promises and physical reality, that's a huge piece of the puzzle here. So that's a $4.40 gap between New York and Shanghai. The source describes this like a powerful vacuum, just relentlessly pulling that US paper price higher and higher, trying to close that gap with what's happening in the real world. And it's not just the squeeze. The analysis points to like a perfect storm of other things happening all at once. You've got big funds supposedly doing some window dressing for their year-end reports. Bullion dealers are apparently running super low on inventory. Miners are making insane profits. And then there are reports that BRICS nations are quietly stocking up on physical metal. It's just pressure coming from every direction. Okay, so with all of that in the mix, what's next? Where does the market go from here? Let's get into the forward-looking part of the analysis, which lays out a kind of roadmap for what could be coming. So the first thing to watch for is Sunday night when the Asian markets open. The prediction is for a potential gap up in price right away. After that, $80 is seen as the next big psychological target, a magnet. Then, looking into early 2026, you've got miners who are going to report these monster earnings, which could pull in a whole new wave of investors. And the long-term idea? That silver is basically being repriced as a real monetary asset again. And this really brings us to the core idea here. The ceiling has become the floor. That old $75 wall of resistance, the theory is that it's now going to be the new foundation, the new level of support for the price moving forward. It's a classic technical concept, and the source claims it's happening now. Now, it's not all smooth sailing. The analysis also throws out some really important warnings for this kind of market. First, counterparty risk. That's the danger that the seller of your paper contract might just fail to deliver. Second, get ready for bigger price swings. Volatility is going to be intense. Third, if you hold physical metal, you really need to think about securing it as its value goes up. And finally, brace for the psychological game. Be ready for everyone to start screaming bubble. And all of this really boils down to one massive question, doesn't it? The source material is making a pretty strong case for a huge, fundamental shift, a super cycle. But how do you, as an investor or just an observer, tell the difference between a real paradigm shift and just a crazy speculative bubble before it's all over? It's the central tension in any historic market.